Our next guest says, depending on whom you ask, August inflation data out this week was either a positive sign or a worrying sign. We were talking about that. Joining us now is Liz Young, head of investment strategy at SoFi. And that was the first thing I'd ask you was the response, the 350-point move that we saw. We had the CPI, which didn't allay anyone's fears, really. The PPI didn't either. And then the ECB raised, and yet take all that taken into account ended up 350 points higher. Why, Liz? What did the market sniff out?
Well, I think there's a couple things going on. I mean, we're obviously closer to the end of this hiking cycle than to the beginning. So the market is seeing that as a positive sign. And actually, since last night, even the probability of a Fed hike has changed a little bit. But last night it was 2.8% for next week. Now it's up to 3.8%. So the market does not expect any surprises out of Jerome Powell next week. And I think we're pricing in the increased likelihood or the increased expectation that we pulled this off and that there would be a soft landing and that we can sustain higher inflation without breaking the labor market. I think some of the negatives that you look at with this CPI report and everything that came out is, number one, the measurements that we have. So we talk about core and removing food and energy from the equation, and then this super core, which also removes shelter from the equation. It starts to sound like, well, if you just take out everything that might be a problem, the number will look okay. But the reality is that consumers cannot remove all of those items from their daily lives. So it continues to take a bite out of that, and I would expect it to start showing up in spending as the months drag on.
We haven't seen oil at 90 for a while, and it doesn't mean it's not going to 100 either, Liz. And I know California, good old California, unbelievable, but $5.52 a gallon. That a lot of people, that becomes a pretty large part of their budget in this environment where we still have inflation. For what we use, up about 6% off of already much higher levels from the past couple of years. I mean, it's tough.
That's right. It continues to take a bigger bite out. We've got gas prices at a one-year high. And you've got, even in that CPI report this week, transportation costs up again, airline fares up quite a bit, and taking a bigger bite out. So, and then this auto workers strike probably not going to help any supply issues that we may have on the car side of things. So yes, consumers are facing an uphill battle. And one of the things that I think we celebrate a lot about the inflation reads is that the growth rate has slowed quite a bit, which it has. And I recognize that, down from 9.1% last summer to 3.6% today is a big slowing, but it's still growing. Prices have not fallen. So consumers are still having to pay that. And as inflation comes down, what happens is companies don't have as much pricing power. They can't pass it all through. They can't justify it as much anymore. And then you start to see margin compression. So despite the fact that this cycle and all of these effects have taken probably much longer than many, many people expected, you are starting to see some of that. And I would expect it to accelerate into the end of the year and into next year as we see margins come down even further.
I don't know whether Hollywood can slow growth in the United States, but certainly a protracted Big Three strike could have an effect on the economy and on GDP. I don't know whether that's positive for the Fed. They don't have to do as much. But my concern, Liz, is that we never get a recession when everyone's predicting one. So people started predicting one. And now no one's predicting one. I saw Jeff Gundlach say, definitely next year. This makes me think maybe it could be the calm before the storm. Haven't enough things been sort of added on to where we do get a slowdown at some point? We start to see the lag effect of all the Fed hikes?
Yeah, well, the reality is there's a lot of chatter out there about this time being different, and because it's taken so long and we haven't spotted this recession that everybody's worried about, that maybe it just will never come. But if you look at the time between when this hiking cycle started, we're now in the 17th to 18th month of that. If you look at the time after the yield curve inverted at the 2s, 10s in a decided fashion and stayed inverted, we're 14 to 15 months into that. This is exactly the time when you start to see some of those issues rear their ugly heads. And I would expect it to start to show up in things like credit deterioration. And you mentioned the ECB before. The ECB has had lower real rates than the other major central banks. So them raising and getting more restrictive isn't necessarily a bad thing. But if you compare that with what's happened with the Bank of England being more restrictive than the other major central banks, they're also experiencing more insolvencies than other economies. So there are natural effects that occur as you tighten policy and as you restrict capital in the economy. And I think the Fed is going to get what they want. They're going to restrict capital enough to bring inflation down. That never really happens without some collateral damage. We're just not sure how much and when it'll actually show up.